Forex trading, a legit opportunity to make some serious cash, or an influencer scam to take your hard-earned money and buy mirror-wrapped hashbacks. I'm Penyo, this is Joos Africa. Let's dig in. Before I give you the juice, let me just say there were a few basic financial terms thrown around. However, this video is by no means a deep dive into the intricacies of the Forex market, nor does it constitute financial advice. I mean, I might just be a janitor or a barman. For more detailed information on money markets, check out the link in the description below. Okay, now let's really dig in. The foreign exchange market is an online marketplace where participants buy and sell currencies of other countries. There are three major regional markets in Forex trading. These are Sydney, New York, and Tokyo. The opening times of these markets overlap across time zones such that the market as a whole is open 24 hours a day. However, the market is not operational on weekends, and therefore it closes every Friday at midnight and opens again on Sunday around midnight Central African time. So, how does it all work? Well, since it's an online market, transactions occur on a global network of servers located in a multitude of financial institutions. Therefore, there's no central Forex bank. Transactions essentially occur directly between buyers and sellers. These buyers and sellers can be banks, hedge funds, and of course individuals. Before trading, one needs to sign up with a Forex broker. Think of a Forex broker as a bank with which you need to open an account in order to start transacting. Traders with very large amounts of money, we're talking millions and even billions of dollars, are often referred to as market makers. This is due to the fact that they facilitate trades by providing liquidity. So you're not literally buying currency from Mpo and selling it to Mbali. However, these market makers do not own the market. It's still free and largely unregulated. The Forex market is one of the most liquid, if not volatile, markets in the world. 2019 saw an average daily turnover of around $6.59 trillion. Not million, not billion. Trillion US dollars each day. That makes it the biggest financial market in the world. To put that in perspective, in 2016, the equities market was estimated to have a daily turnover of about $84 billion worldwide. Anyway, of all those trillies, Mzansi sees through around $20 billion of transactions every day, while Nigeria lags way behind at around $315 million of transactions every day. Who's the real Mariki now, Nigeria? In terms of trading software, the most popular one is a free platform called MetaTrader. Some brokers will recommend their own trading software, but more often than not, it's the same MetaTrader, albeit with a heavy face beat. Think of MetaTrader as a WhatsApp group full of people buying and selling currencies. The basic principle of trading is to profit from the fluctuations of a currency's value over time. It's important to understand that Forex trading is fundamentally speculative. A buyer buys a currency speculating that at a later point its value will be higher, at which point he would sell it and profit the difference. A seller, on the other hand, speculates that a currency's value will drop at a later time and therefore sells it at its current high price and buys it back later at a lower price in order to again profit the difference. At their core, every transaction is a legal agreement between traders. That is why Forex trading is also called CFD trading, contract for difference trading. Now, remember that pesky little word speculate? What happens if a speculation is wrong? No price for guessing, you lose money. In a loss-making scenario, a buyer is forced to sell at a low price, and conversely, a seller is forced to buy at a high price. Again, this is a very basic explanation. We haven't even gotten to talking about leverage, stop losses, and all of that. Essentially, that is how traders lose money and make money for those mirror-wrapped hashbacks. I mean, how else do they make that paper? I don't know. I'm just a guy on YouTube wearing his favorite knockoff Versace shirt. Is it even Versace? What I do know is some traders trade and some traders teach. And you know the old adage, those who can do, they trade, and those who can't, workshops, WhatsApp groups, seminars, yeah. But what exactly is being taught? Isn't it all speculation and guesswork? Kinda. Bear in mind that even investing in shares is just as much speculation as is Forex trading, however in a less volatile environment. This is where trading strategy comes in. A trading strategy is a technique used by a trader to determine whether to buy or sell a currency at a given time. There are two classes of trading strategy: technical analysis and fundamental analysis. Fundamental analysis is the study of the underlying socioeconomic reasons that might affect a currency's value, like the announcement of interest and employment rates. But they can also be as vague as Trump tweeting about grabbing kittens or Ramaphosa reshuffling his wardrobe at midnight. That sort of stuff. Therefore, fundamental traders speculate based on their interpretation of economic news. On the other hand, technical analysis relies more heavily on pattern identification and statistical analysis of a currency's value over time. The time can be as short as 1 minute to an hour, or as long as a couple of months to over a year. Technical traders speculate based on their belief that there are inherent ebbs and flows in currency values which inform their predictions. Both technical and fundamental strategies can work. However, often the deciding factor of which works best heavily relies upon the temperament and discipline of a trader. I don't mean to get preachy, but you also have to know when to step back when you're doing badly and when to walk away when you're actually doing well. Even so, fundamental news can prove as useless at speculation as historic patterns and statistics. The complexity of figuring this out is why I think there are more successful forex trading teachers than you would find successful forex traders. Personally, I haven't met a successful forex trader who trades exclusively. Have you? Anyway, it's believed that 60 to 70% of traders lose money, so the odds are certainly not in your favor. But if your losses pull up and you find yourself balling out of control, don't forget that this is not lottery money. So you do need to pay taxes on capital gains from forex trading. So pay your taxes before leaving it up on Instagram. In short, forex trading itself is not a scam. It's an essential economic activity that drives global commerce. But ultimately, it's still based on speculation with often difficult to prove strategies. So with anything this complicated and with this vast a grey area, there will always be some chances ready to take advantage of others. My advice is read. Understand the game and know your risk appetite before you dive in. Like any business, the less you know, the more likely you lose money. If you've made it this far, you deserve a degree in patience. I hope this was informative and at least a wee bit entertaining. Although this video was requested by a large chunk of our 3 million subscribers. What? What?
It's over 3.
Yeah, I said 3 million.
3.
Anyway, let us know what you think in the comments below. If you enjoyed this video, please like and share it. Till next time, remember to be kind. Please subscribe to Joos Africa for more content. Follow us on Instagram and Twitter, and if you'd like to help us grow, please support us on Patreon.